The main thing is the competitive landscape. That's what's creating the dislocation. People are looking at Microsoft and to some extent, Google's Workplace. And there's other competitors out there, from Five9 to Ring Central to Avaya. And I think, ultimately that's what's creating it. But our opinion is pretty straightforward. And here it is. All right. Hey, everybody. Sean Emery, the co-founder and chief investment officer of Avery and Company. We have a company primer for you today. This is the Inside Scoop podcast. We're taking a deeper dive into Zoom today. And I think what we want to do on these company primers is really highlight, companies that we think are dislocated one way or another, and then provide some sort of framework for you to, gauge for yourself. Again, these aren't recommendations for investments or anything. They're more, inside the inner thoughts of, how we're thinking about, investments, industries, and such. The storyline today is, we think underneath the surface, this was a COVID beneficiary. It's been unloved ever since. We think underneath, again, the noise presents somewhat of a compelling opportunity. We'll go over, what they do, their products today, where we think the product portfolio can go in the future, who leads the team, what's the compensation structure, and, are they truly aligned with investors, and what's the competition looking like? Ding, ding, right there. That's obviously where, a lot of, I think, the dislocation comes from. But, are there economic moats, or are there any, competitive advantages that we think can help them defend competition? Where does growth come from? And then how do we think about, valuation in terms of a framework? So expect that going forward with these primers. And that's ultimately what it's about. So this is Inside Scoop podcast, company primer edition. If you like this, make sure to like it, subscribe, share with your friends. Only then we'll know, that you want more of these. So before that, here's a quick disclaimer. This is the Inside Scoop podcast, an investing and research focused podcast owned by Avery and Company, manager located in Miami, Florida. Investing where the world is headed. This should not be viewed as a recommendation for the purchase or sale of any securities mentioned. If you'd like to learn more about Avery, please visit our website at avery.xyz. That's www.avery.xyz. Make sure to subscribe to the podcast. It's a 5-star podcast, so that always helps. So if we start with the product here, Zoom is a household name. There's no, story about that. And Zoom to one extent is synonymous with video meetings, and that's a powerful thing to have. Like Kleenex and some of the other brands that have come before them. Just having that brand recognition doesn't really allow a company to operate, forever. But we do think that for a time being, that really defends themselves, allows them to have that brand power, and doesn't allow maybe upstart companies to really gain traction. At the heart of Zoom's offering is really Zoom Meetings, a robust video conferencing solution. They have the free tier, they have the paid tier, multiple paid tiers now, bundled solutions as well. We think Zoom wins specifically on the product side, just based on their user-friendly interface, cross-platform compatibility, and most importantly, and reliability. These meetings have to work every time and be pretty seamless to get on. So that's really the starting point, the jump-off point for Zoom. For someone looking to, analyze Zoom, they should be looking beyond meetings, though. At least in our opinion, we're investors here, so keep that in mind. But we're trying to be very pointed in terms of what we're saying. We want to be real in terms of what we're saying. What's our opinion? And if there's ever any feedback, we're always happy to listen. But they have to move beyond meetings. So there's Zoom. Zoom has Zoom One. That's their bundled offering. That's seen strong uptake recently. It incorporates some of their lesser known, but I think pretty valuable offerings. So you have Zoom Team Chat. This is their version of Slack, or even the communication portal people use within Teams. It's really for internal teams to communicate, collaborate. We use it here at Avery, and we were Slack users prior, and they have this little migration tool where you can take all your messages and channels and seamlessly move Slack to Zoom Team Chat. So that helps, and also has a pretty robust app ecosystem today, and they're continuing to add there. It's embedded in Zoom One, and that's the theory. You get meetings as part of that Team Chat for free in theory. On top of that, you get Zoom Whiteboard, which also comes with it. So if you're a user of like Miro or FigJam, or you use like whiteboarding, then having this for free and really incorporate it into remote meetings makes sense, and having all of that talk to each other. They have AI companion that comes with Zoom One as well, and that provides real time translation. I think most importantly though is their AI summary capabilities today, and it's really a feature, but we think it's best in class. And some people in the industry that we've spoken with also believe it's best in class. We use it internally. I think they're taking a differentiated approach here in AI. Not only do they have an investment in one of the leaders in Anthropic, but they're also taking a federated approach. So they're not relying on any single foundational model. They're actually using multiple and then building on top of it, and then obviously directing and redirecting, call it workloads where it needs to go. So we think that's important for the future of them. Their product, their AI product, really their summary really competes against the Otter AIs and the Fathoms, some of the stuff you see when you're in meetings. And Otter AI was really first to this kind of note taking crowd, and Zoom Team Chat, Zoom AI is first class. It records your meeting. You'll have a pretty detailed summary. You can edit it, post if you wanted to fix some stuff, but then it has like your takeaways at the end. And for us internally, it's really powerful stuff. They also have other stuff like Zoom Clips, and that's what it sounds like. It's like clips of videos. It's really around asynchronous activity that you do, within your team. You can set up, demo videos or how-to videos. If you were logging into a website and you wanted to show someone, you take a Zoom clip. This is bundled in, again, into like a $12, $13 a month Zoom One bundle. Everything I just talked about is actually. And the Zoom Clips is the equivalent of Loom. That was just actually purchased by Atlassian. So Loom was, the big kind of asynchronous, clips or video recording tool that a lot of people use for demos and such. Again, it's bundled in here. And that's it. Like inside your workplace, we think there's more stuff that they're doing. They have notes on the way, docs on the way, calendar on the way. They just shared many of these things at their recent Zoomtopia. So I would say those are more like features and adjacent products. But really to move the needle here in terms of like revenue generating products, you have to start talking about Zoom Phone, Zoom Contact Center, Zoom Scheduler, which is the equivalent of Calendly. We use it internally as well. We switched. It was obviously cheaper and more embedded into our workflow. Zoom Webinar and Events. Clearly, we all know what that is. And then Zoom Rooms, which is really for in-person office. Making sure you're if you're in your office and you wanted to go to the conference room, you can seamlessly move from Zoom on your desktop to Zoom in the conference room. These together put Zoom into really other parts of your organization. So it moves you from this external Zoom meeting functionality to really more internal usage. Zoom Contact Center obviously is real deep internal. Zoom Phone is really internal. Zoom Rooms is really around being internal. And I think that's a big distinction here, like internal usage of products versus external usage products. And I think Zoom's product portfolio continues to go in that direction. This will drive growth, attach rates, and therefore, as people get into multi-products, I think that ultimately reduces churn as well. And that's the story. Like from a product perspective, is like they continue to have to evolve and go left and right. Now, the problem that they're ultimately trying to solve here really is around, collaboration, communication. It's not hard to understand the problem, but I think if you really think about it, the question is, hybrid, remote, work from home, work in the office, like what's ultimately going to be the end result, and where does the world normalize? I think, we could say today that the world's, normalized. But remote work, even if it's one day, even if you have 20% of your workforce, let's say your sales reps are all out in the field, like having the remote capabilities, having that collaboration seamlessly makes a lot of sense. So it makes a lot of sense to have that internal, external communication. But most importantly, you have to have things like governance and traceability and security involved. And that's where having like an enterprise ready, product makes sense. This is happening, in several ways. First, if you're looking for tools to help facilitate, um, communication, you have everything from, again, Zoom Rooms to Zoom Phone to Contact Center to Zoom Clips. Now, the next kind of, I think, phase of adoption or like, macro trend that's taking place is really around, cloud. Companies don't necessarily want to manage all of their own internal stack. So the problem there is, again, you want to turn to more cloud-enabled products and as a service products. And, Zoom Phone is just that. Bring your own device where, you can have, today it's like, or really still today is you have phone lines tethered to physical cables in offices. And with Zoom Phone, you basically have, internet-based phones in the office, bring your own device mantra, have employees use Zoom Phone on their phone, and they can have their personal and business line all on one device, with governance and traceability and and reliability. I use it myself on my personal device. I have Zoom Phone, so you call my office line, it rings the same device. Also, my desktop app for Zoom, if you're calling me, it'll show up on my computer, and you pick up normal. So customers again are looking for cloud solutions. Then you have like governance around all this stuff and security, and Zoom, FedRAMP and all the other certifications across education and healthcare. Really important distinctions to have, or accreditations to have, but they also don't use the public cloud in any sort of meaningful way. And I think that ultimately gives them full control of their infrastructure for security and governance purposes, but also for computing costs. We've heard that from other companies as well, like Dropbox, that went off the public cloud. So the general thesis, or what Zoom, how they build product is, they launch in the public cloud, then they optimize it. They optimize the product, they optimize the spend, and then they move that onto on-prem or private cloud. So we think that's important. The next phase I think that's important to look at is leadership. Are they aligned? Are they have they executed well? Things like that. So Eric Yuan, he doesn't necessarily need a real introduction. He was on the early WebEx team, left there, started Zoom in stealth mode, quickly ramped up. I think the key characteristics of him, however, are he raised a bunch of capital that they never used and left on the balance sheet. So he was always prudent. And you're seeing that today, $6 billion of cash, net cash, so that, no debt. And he's really shown this disciplined approach to cash management. And we'll talk about that more shortly. But Eric Yuan, Kelly Steckelberg, the CFO, we think, they perform well from an operating standpoint. They came to market in terms of, call it to the public markets, 2019 timeframe. And they've been really prudent in terms of capital allocation, not, going over their skis one direction or the other in terms of investment. And they've also grown their business significantly. If you go back to, obviously pre-COVID, $1 billion in revenue, $4 billion today, all that happening in a really condensed period, which, from an operational standpoint is really difficult. And all through that process, obviously, margins and revenue has grown, even since COVID, they grew 4 quarters or 3 quarters in a row at like 300+%. And even today, they're still growing and expecting to grow. And that's really happening without a lot of, the cross product adoption just yet. There's some there, and I'll talk about that, but that's just the core product. So it's pretty interesting to think of it in those terms. Eric Yuan, significant stake in Zoom. So is he aligned, north of 20%? That's assuming, his current stake plus grants. He's compensated well. He makes $450 a year, but also the performance bonuses and then, long-term equity awards that he receives. The key on the performance bonus is 70% of that is tied to, monthly recurring revenue. So obviously, really tied to top line. You can't really, adjust top line performance. And then 30% is, tied to non-GAAP operating income. And there, obviously, stock-based comp comes into play, and I'll talk a little bit more about that. But net over the last 4 years, they do these these kind of like 4 or 5 year long-term grants, which are pretty darn big. But 18 million a year on average. They had a big one, 2 years ago. But on a 4-year period, it nets out to 18 million a year, which is a lot of money. But that puts them in 50 to 75% percentile of kind of enterprise SaaS compensation. Now, turning to the competitive positioning, I think this is arguably the most important area from a understanding standpoint, or having a point of view. This is probably where a lot of the dislocation does come from in our conversations with, other people in the investment world. I think that's the first reaction is, what about Microsoft? So the main competition here remains Microsoft, to some extent Google, given the workplace product. There's also competitors, from the likes of WebEx on meetings, Five9, 8x8, RingCentral, Avaya when it comes to phones and contact center. Salesforce obviously owns Slack, so they compete on, that collaboration space. But if we're looking at, who truly competes on a cloud first, fully unified, meaning going from chat to video to phone, the biggest one out there is obviously Microsoft. And for us to understand that, we think we have to look at it in different ways. What do the stats say, and what's the makeup of the market? But we think generally it's overstated in terms of competition for Microsoft. It's there, so don't get me wrong, but this is how we're thinking about it. Number one, there's a massive ecosystem out there of companies that are not using Microsoft. So think of, best in class product company or companies using best in class things like Slack, Zoom for video, Google for their, docs and sheets and stuff. And then they're also using things like Dropbox and Box and, just best in class. Then you have companies that compete against Microsoft. So there's this whole suite of non-Microsoft usage. And then there's this whole, competitive dynamic towards Microsoft. And, as Microsoft gets bigger and bigger, they compete against more companies. LinkedIn, Activision now, Xbox, email solutions. And that's why you're seeing companies like Dropbox or Intuit, they're using Zoom end to end across the board, across many of the products I mentioned. So the rationale there is who wants to have all their communication running through your competitors' data centers and applications. And, it's not to say that anything negative is actually going on, but it's, if you're planning and Zoom's actually a good product, why not go with that? And it's priced really appropriately. Two is really, the data. So we look at the Okta business report that they publish, and we went back and looked at all of them, and we look at them all the time. But, this past report, you look at Okta's customers, they can basically see which one of their customers. This is for single sign-on, logging on to applications and software usage. They can see who's using what in terms of cross usage of software apps. And long story short, here is the latest report showed that Zoom actually increased its penetration inside of Microsoft 365 accounts year over year. So they're actually growing inside of Microsoft accounts, which is, somewhat counterintuitive to what the narrative is. And if you go back to the growth profile of they've grown ever since COVID, yet, their second and third order products outside of just meetings has been actually, a small part of their business up until now. I think that also suggests the same thing. And the niche for them, I think, is really the product works, and that gives them kind of a leg up in terms of quality and reasons to, stay put. Zoom is also known to price aggressively. So Zoom One is $13 a month. And, if you do the math about the other products I talked about, Slack, Zoom, Otter AI, the Miro, FigJam, Calendly, the replacement for Scheduler, all those combined would run you about like $40 to $50 a month. You get all that functionality for $13 to $17 a month with Zoom. So for another $12, you now have Zoom Phone, which again takes maybe the total with them to $25 a month. But that would compete or compare against, $50 to $60 for a best in class solution. So they're priced really well. So that's really it from a, what I would say more of some competitive positioning. But the key question long term is, have they established a moat? Are they developing a moat? And what could that look like? So for us, we think the really thing that sticks out. So we know that Zoom Online Business, which is customers that come on the Zoom platform without reps, this is about 40% of revenue. And in theory, it's the most susceptible to churn, just given its lower user counts inside of these organizations. And therefore, they likely use less products. And churn here fell to 3%, which is, the lowest it's been, prior to COVID. So something is proving out, I think, with revenue rising since COVID, their enterprise business doing well, of which they have, 219 accounts. That's growing recently. And again, those are basically accounts that have a sales rep attached to them. So it's not like truly enterprise in terms of how people, define enterprise. And these are, again, people that are using Zoom, whether it's through a sales rep directly on Zoom or resellers. They have over 3,700 customers paying $100,000 or more. And that grew double digits here recently. So the question there is what could be driving this retaining of users and revenue growth across the board? And again, not to say that revenue is growing dramatically. You're talking about single digits today. But I think bigger picture is when you look forward and we'll talk about growth in the growth section. Can they grow and how? But on the moat side, we think, intellectual property, brand, owned data centers, reliability. These are important. I think medium term, shorter term, these are durable kind of competitive advantages they have. But we do think over time these will be replicated. So today they're a core advantage, futuristically more commoditized. Then we move into network effects and thinking about, is there evidence of network effects at play, but maybe less durable than, let's say, credit card networks or social networks. If we're using, Metcalfe's law, where networks become more valuable exponentially really as more users join, then I wouldn't characterize Zoom meetings as a likely fit. However, I do think there is some value and durability in knowing that someone on the other side um, likely knows how to use it, use Zoom, has a Zoom account. Therefore, it's a credible solution. So network effects. There's some aspects here that I think you could apply, but bigger picture, I don't apply too much weight to network effects for Zoom. Switching a cost, Switching costs. This is arguably where I think Zoom has the biggest uh, moat slash potential moat and the biggest opportunity to drive a wider moat, over time. And it's the release of many of their recent products over the years. We have seen, pretty significant uptake in full suite adoption. I'll talk more about that. With more products being attached, as we have seen kind of with other companies, it really does create real stickiness, and there's a correlation to churn. So, and when I say that, I'm looking at other software companies that display product growth and therefore further or reducing churn all across the board. It makes some sense. If you roll out Zoom Phone to 2,000 employees, get them using Zoom, Team Chat, then they're using meetings, and then they're becoming a Zoom scheduler client and scheduling all their meetings on there. And then they have AI functionality and getting notes and summaries from AI and clips as well, and having a database of all these clips that they've maybe they're showing their colleague how to do stuff, and many of those clips are saved for future use. You can obviously see how that drives switching costs. And one stat we know is that back in 2022, they had an investor day, and at that time, they had about 10% of enterprise customers using 3 or 4 products. Obviously, today they have more products than that, but that group made up 50% of ARR and annualized recurring revenue. And that ARR at the time was growing 45%. So I suspect those numbers are higher today. And the potential product adoption is also, higher than today. Now, growth, what are the two, or what are the main areas? And we think there's 2 growth areas, and we call it like a growth algorithm. And then we'll talk about valuation framework. But growth will come from, number one, reduced churn, which sounds counterintuitive, but obviously, if maybe there's less people on the top, but you're reducing churn, obviously you can you can improve your revenue profile going forward. And we think that ultimately come from product attachments, in addition to something like stable macro, where if people are firing employees, you're naturally losing seat counts. And as that stabilizes or even grows, you get growth from that. Now, the second, is growth in products, and that's probably pretty obvious. But Zoom Phone comes in around at $13 per user per month. They have gone from 1 million Zoom Phone seats to 7 million, growing double digits today. They're the fastest cloud phone provider to date. And, channel checks, when we talk to agencies or resellers, they verify that, Zoom's a really strong player here, both on the product side and the pricing side. There's over, 460 million desktop phones. And this is to kind of put into some perspective. And that equates to, 25 billion in revenue. And this is us just simply assuming, okay, $5 per user per month across that base of phones. And then at a current run rate of, $500 million today for Zoom Phone, double digits, obviously there's real opportunity there. They're not going to capture that whole revenue opportunity, but it does suggest plenty of runway. Zoom Contact Center, big opportunity as well. If we do kind of similar math, try to size it up, Zoom Contact Centers for support agents, and the list price there is $79 per user per month. And if you take that, you use an annual rate of $2 million per support team. That's 2,000 users at that per user per month rate. Essentially, that size is a $2 million run rate opportunity. Now, if we assume they take 30% share of just the Fortune 500 and assume 2,000 seats each at that list price, that's $300 million in revenue. And again, there's more than the Fortune 500. Seat counts are much bigger than 2,000 seats at many of those. And the list price actually, would likely be lower than that with those type of companies. But it does suggest the opportunity as companies move from on-premise contact center to more cloud centric. And that's it. I think that's the biggest 2 drivers. Now we also see them using their $6 billion of net cash and either buying revenue from other areas like communication platforms. They attempted to buy Five9. We could see other attempts in this area for sure, or we could see them moving more into productivity and collaboration. So think tools like Box or Dropbox or Asana, or even taking Slack off of Salesforce's hands. We don't have any insight into which one, but we've speaking to them and also hearing them speak. in group settings, there's definitely interest in, more productivity and collaboration tools. Last section is really around valuation. I think it starts with the current valuation and cash position. If you assume that Zoom is a durable, long-term business driven by multi-product portfolios and attaching those products over time, moving into areas like phone, contact center, which they have done so there's evidence, moving into other areas that make sense. Here at a 10 to 12 multiple free cash flow, we don't think that makes any sense. Enterprise SaaS companies, they've warranted 18 to 30 multiples at when people recognize that these are durable, long-term, sticky businesses inside of enterprises that don't want change. And that's switching costs. That's ultimately where, that competitive advantage eventually comes from. Nearly 30% of the market cap is cash. It's probably higher than that now. And, they continue to reduce their stock-based comp as a percent of revenue. There was, a couple years ago, they re-upped some of their stock-based comp to their team as the stock fell, because obviously they were giving grants and shares at $600 a share. We weren't anywhere close to being investors at that point, but they were giving their employees at that. And obviously, as the stock fell, they had to true them up for the sake of retaining, and that's showing up in stock-based comp today, and that'll start to subside over the coming years. Now, in a situation where growth does not accelerate, we also think that there's valuation support here and capital, like balance sheet support as well, where maybe private equity or strategic buyer comes in. So there's some of that in terms of margin of safety, but the valuation framework is simply around multiple expansion, getting multiple expansion driven by confidence in that this is a durable long-term business, and then two is the product attachments and attach rates, which will ultimately drive revenue and earnings over time. You get that, you get some pretty interesting figures. Not to share them on here, but I think the last thing is what could go wrong. So it's all about execution. Can they continue to drive the growth of their Zoom One licenses and really bundle Zoom Phone and Zoom Contact Center? Zoom Phone is 10% of revenue. Zoom Contact Center just has 700 seats now. They just launched it, which is a really big deal. They just landed a 2,000 support staff and some pretty large wins. But execution, if they do this, they should continue to keep their customers and fend off churn. Now, another issue, that could potentially come up is they have a lot of cash. They've been prudent, but do they do a mega acquisition that is strategically, out of focus or very expensive? I would say those are the two main things about that. So that's it. I think we covered, everything from, compensation inside the organization, the product portfolio. I think that's so important. The product portfolio, as that ultimately is what drives the value of this business. And then having a valuation framework along with, competitive dynamics. All of it flows together to make a real decision here. But with that, go try Zoom One. If you have Slack and Zoom, or Calendly or Miro, go from Calendly to Zoom Scheduler. You'll save money. Go from, all that, you'll save, a lot of money. I talked about it earlier. And that's it for this company primer. I hope you liked it. We'll continue to work on these. But make sure to subscribe, like this, share with friends. The more of that, the more we want to share our findings with you. But with that, have a good day.